Depending upon the markets, the book value could be higher, could be lower than the market value. And net fixed assets are things like plants, property, equipment, things like a factory, machinery, other equipments, cars, trucks, what have you. By the way, certain assets can be amortized. It's similar to depreciation, but it's not necessarily for physical assets. Actually, certain assets is also subject to what we call depletion, especially for assets that are natural resources. Suppose you bought an oil well with proven reserves of 10 million barrels, and you only extracted 1 million barrel this year. You depleted 10% of the proven reserves. So you can write off 10% of the original cost as depletion cost. And for the purposes of this class, that's not something you need to worry yourself about. But if you see it somewhere, that's what that means. Or if you're using a car, you're using a truck in the construction business, it has a tax life of, let's say, 150,000 miles, and you drove it 50,000 miles this year, one third of it is depreciation costs. Real estate in general, which are buildings and land. Land is not subject to depreciation, but buildings are. I think that's subject to 40 years, something like that. Don't quote me on that. I am not an accountant. Not that there's anything wrong with that. And you also have what we call intangible assets. The assets types that I listed at the top are tangible assets. They have an independent physical existence. A computer has a physical existence. A land has a physical existence. But certain things do not. Can you think of any? Remember, asset is something that is of value to the firm. Can you think of an asset that is of value to the firm, but it doesn't have any physical existence? Hmm? Trademarks, especially if you purchase them. Because if you haven't purchased them, you just registered it. Accountants are going to list it as zero, which means it's not going to be listed as an asset. That's not because it's not valuable. Who could argue that Coca-Cola is not a valuable brand? But since Coca-Cola did not pay for that brand, uh, on the books, it has zero value. Accountants do not attach a value to an asset unless they have a systematic way of doing so. I always give the example of Steve Jobs. You guys know who that is, right? If you looked, I mean, he died, what, almost 10 years ago, maybe more. Uh, if you looked at Apple's books, you're not going to see an item that says Steve Jobs, $10 billion or $100 billion. But the day Apple announced that Steve Jobs had terminal pancreatic cancer, Apple's stock went down 10%. And those days, that money was about $100 billion. So the market value of Steve Jobs, as market perceived it, was 100 billion. But in the books, it's zero. So market value and book value are two different things. So Steve Jobs is another, technically he has a physical existence, but it is his mind that was the asset or the knowledge contained therein. So that's an intangible asset. If Apple actually had bought Steve Jobs from somebody else, that would have been a book value for that. Sometimes you acquire a brand and you pay something for it, you'll see that. Among other things, copyrights are similar, patents. You may be a drug company. Instead of producing a drug yourself, you actually bought the patents from another company. And big companies do that all the time. Since you pay something for it, it doesn't have a physical existence, but it's going to be listed as a intangible asset. There is one thing you may not have heard. It's called goodwill. Okay, let's look at Google for that. It's all assets, non-current assets. Oh. Out of $400 billion in assets, about 30 billion in Google is goodwill. Anybody actually knows what that is? What's the technical definition of a goodwill? I am sure you haven't heard about it in your basic accounting classes. Maybe you should have, but I'm very confident that you have not. It has nothing to do with what you're thinking. It is the value of goodwill company has with the overall public. It has nothing to do with it. When you acquire an asset, you pay something for it. Google purchased YouTube in 2004, I believe, or five, for $1.6 billion. At that point, YouTube did not have a single dollar in sales, but they had some financing, so their net equity was $500 million. Since we do double entry bookkeeping, I paid 1.6 point some or something. I brought all the assets and liabilities of Google, YouTube into me, but that's only five. Things have to add up. So I book 1.1 billion. The excess money you paid over and above the book value of an acquisition is called goodwill. So that 1.1 billion was goodwill. Obviously, Google bought other stuff over the years, so they accumulated goodwill. In the old days, until about 2006, I believe, you actually had to amortize Google goodwill over 40 years. So if you had $1 billion of goodwill, you had to write off $25 million every year, just like depreciation, even though it's not a tangible asset. Then FSB, which is not to be confused with the FSB in Russia, which is the modern equivalent of KGB. FSB, Financial Standards Board, or FASB, I'm sorry, Financial Accounting Standards Board, have decided that you're going to keep goodwill as it is, except every statement period you're going to subject it to an impairment test. So did that thing lose any of its value? If assume YouTube experiment didn't work, people were not interested in watching cat videos. They are, and YouTube is responsible about a third of Google's revenue right now. So doing a rough back of the envelope calculation, YouTube's value would be about $600 billion. It is one of the smartest ever acquisitions in modern history. But there were other acquisitions at that point that was considered smart. Wall Street Journal bought MySpace. Anybody remembers or heard of MySpace? It is nowadays where most of the it's the basically dirtiest things you can find outside of dark web. They're in MySpace. It's basically all child predators or scammers. They're all in there. Wall Street Journal paid $500 million for it. Of course, this was before Facebook. Facebook came along. Nobody cared about MySpace. MySpace is worth practically nothing now. So at that point, I don't think MySpace had assets net worth more than 100 billion or so. So they booked the 400 million as goodwill. But probably by 2010, they recognize that this asset is not worth what it was. You recognize that goodwill impairment, you take it out of goodwill, you recognize that as a loss. Let's stop here today. On Monday, I'm going to talk about income statement and the concepts of cash flow. All right. So please come to class having read the chapter so that I don't have to define every single term. Is listening to me what it is from me. If you can read it from the book.